Hello everyone and welcome back to the Velocity channel where this is your bridge to financial freedom. Today we're going to go over some of the top 3 mistakes to avoid while you're doing velocity banking so that you can maximize your money, you can maximize your bank accounts, and maximize all velocity accounts that are associated with velocity banking. But before we get into that, please like, share, and subscribe all over the world so that people all over the world can realize that velocity banking is what they've been missing for their finances. Are you ready for this? Top 3 mistakes to avoid. Number 1, negative cash flow. We definitely want to avoid negative cash flow, and this is maybe one of the obvious, but it can be misconstrued into a realization of, man, wait a minute, with velocity banking, I'm moving all this money around. It doesn't matter if I am negative in cash flow each and every month. Well, hear it from me, okay? It does matter, all right? Now, even though you can flow negatively in cash flow each month, that's not recommended. Why? Because you may catch yourself not being able to pay your obligations as you're negatively cash flowing. You see, let me give you an illustration of what I mean. Negative $1,500 a month, all right, is actually less than negative $131 a month. Now remember, I do illustration after illustration on how you can flow, you can negatively cash flow each and every month, but that's if you have some money in the bank to, right? Like say for instance, say you got $5,000 in the bank, okay, accumulated. You can actually use that to pay the car, the credit card, and the mortgage, but not just any old way. You're not going to pay it. You're not going to divvy up your $5,000 the regular way. You've got to divvy it up in a way where you're taking away the interest that is being charged on your car, your credit card, and your mortgage. What's the way to do that? Then I hear someone say, put it to the principal. Absolutely. Make sure that you're chunking some amount to the principal to get rid of that interest. Why? Why is that so important? Because the interest feeds off of the principal. That's why. And so if you've got the $5,000, we need to show you a way to strategically place that money towards 100% of this money towards the principal in a way where you are no longer negative in cash flow. All right. So that's actually just one tip, right, of 2 more to avoid negative cash flow, because of course it may go without saying, but I'm not sure. I just wanted to make it clear. The goal is not to negatively cash flow. Right? And this is I'm not trying to be funny. The goal is not to negatively cash flow, but to positively cash flow, because you'll see when you positively cash flow, you'll be able not only to meet your obligations, but even more, and place these into wealth building assets. All right. So please, please, please. Number 1, go ahead and avoid negative cash flow if you can. Oh, this is a huge one. So focus on the interest rates. Now, I hear some people say, well, wait a minute, CJ, interest rates are important. Are they? Are they? Watch this, okay? 5% or 50%. The focus is on interest rates, and some people focus on interest rates too much, all right? I'm not saying that they're not important. I'm just saying that they are not as important as other things, and we're going to get into it. So back to the illustration, 5% or 50%. Which one would you rather pay? All right. Of course, a lot of people right now are saying 5%. I hear you, right? Okay, now, which one would you rather pay? Would you rather pay 5% of $100,000? We're just going to write the zeros out, all right? Put a little comma there. Or would you rather pay 50% of $100? And I'll give you some time to answer. This may be a tough question. Go ahead. Which one would you rather pay? 5% of 100,000 or 50% of 100? Now listen, I would rather pay 50% of $100. Do you know why? Because it's not all about the interest. But that's what happens when you focus too much on the interest. You're forgetting about the time. You're forgetting about the balance. You're forgetting about all the other things that are more important than just the interest. And so there you have it. You're focused more on the interest than you are improving your financial status. You're focused more on the interest than you are improving your credit building. You're focused more on the interest than you are learning about velocity banking and actually getting ahead and making sure that not only all the obligations are paid, but so that you can have the peace of mind in knowing you know another banking method that's far superior than perhaps the traditional banking methods, okay? Hey, buddy, look, it's right there before you. I didn't convince you with a story, did I? 5% of 100,000 or 50% of 100? We got to start focusing on the bigger picture. The reason why it's better, right, to make sure that your cash is flowing, right, throughout your lines of credit rather than just sitting in your checking and savings account is because of the principle of stagnation, right? Whatever sits decays. And as your money is sitting in the savings, as it's sitting in the checking, as it's sitting and not gaining, right? It's losing because of that inflation rate, right? Because of that inflation. Okay, so we want your money not to lose value, but to go up in value. And what happens when you know how to pay your lines of credit? What happens when you know how to pay your credit cards? Are you a victim of a line of credit increase? Are you a victim of a credit card limit increase? I think so. And it's because you didn't just focus on the interest rates. You took other things in mind, like the time and then the balance as well. We need you to do the same, all right? Listen, that's number 2. We're going to the third and final one. I think you're going to find this very helpful. All right, the third and final mistake to avoid when doing velocity banking is accumulation illusion, or you can simply call it AI, okay? We're going to go ahead and put it in brackets here in a square. AI. AI, sometimes it's dangerous, all right? Accumulation illusion. What do I mean by that? Well, what would you rather have? Which one would you rather pick? Would you rather have $1 million one time or $5,000 each month? So your choice is $1 million one time or $5,000 each month. Watch what happens as we subtract, as we do some of these mathematical equations here, so that you could further know and learn why you should choose one or the other, all right? Now look, I'm not going to persuade you either way. I'm just going to write down some numbers here and you do the deciding. Is that okay? All right, so I'm going to go ahead and subtract 5,000 from the $1 million, right? And you know what that is, right? It's less than $1 million, right? So now, right, I'm going to subtract 5,000 from here, okay? However, remember the next month I'm getting paid the $5,000. On this one, I'm not, okay? So watch this. I'm going to go ahead and I'm going to add 5,000 here, right? And let's say I'm going to go ahead and subtract 5,000 here, because guess what? Time goes on, right? And of course, we subtract 5,000 here, all right? All right. But wait a minute. $5,000 is going here because it's next month. But guess what? We just have 1 minute. Listen, I'm going to tell you something. This is why you see people working in places where they don't want. Absolutely. I'm not naming any names, not even naming any age brackets. Okay? But when you retire, which one would you rather have? The one time or each month? And a lot of times when people are doing velocity banking, they forget, my goodness, I got paid out, and I got paid out a lot. $1 million is a lot, especially the 5,000. But what's coming in next month? Right? Now, this person, because they're a real estate investor, guess what they're spending that $5,000 on? Not just consumables, right? Because they're producers. Not just consumables, because sometimes they're lenders, right? What are these people spending the money on? Listen, it's subtracting. It's subtracting from the $1 million that they have. So how long are they going to have that $1 million versus to someone who has the 5,000? And oh, by the way, they may have another 5,000 coming in as well, right? We don't want to get caught up in the accumulation illusion, meaning just because it's a big number does not mean it's going to be like that for the rest of your days unless you can get it to do this each and every month. All right. So don't get caught up in that trap. Please, please, please make sure that you're paying your debts, right? From this, let's go ahead and take the $5,000 here and then move that to perhaps a line of credit or a checking account. But let's not forget how to pay that obligation. Let's make sure we are saying, hey, I want to put $2,000 since this is gained, back, right? Whether it's in the line of credit or checking account, you can do the math, right? I've gained the $5,000. Can I go ahead and put this to work to pay down the principal off of the car, off of the loan, whatever it is? Does that make sense? So make sure you're doing the chunking of principal, okay? And make sure that you know, right, the difference between accumulation and cash flow. Now, you be the judge on which one is more efficient. And me, myself, I like both, right? Because we know how to use it. But when choosing, I got to go with infinity. Let's keep going. Let's keep the cash flow going because it is so much more important in terms of priority. All right. So folks, thank you so much for tuning in. If you got any questions, don't hesitate to go ahead and comment, schedule a call with our team. We'd be happy to help you. God bless, and you guys take care.